welcome back. I am super excited today because I am chatting with Alex Garber, who is a CPA accountant. And one of the things I actually really love about him is not only does he practice, but he's actually a professor and teaches about tax and accounting. And I think that's going to be really great because we're going to be able to understand what he said. You're going to be speaking in plain English, right?
I will try my best.
Awesome. So glad that you're here.
Thank you. Thank you. Nice to be here.
So we are going to be chatting a little bit about everything that has to do with tax and buying your first house. So
exciting times.
It's gonna be good stuff. So the first thing that I wanted to maybe ask you about is like the most common element is the RRSP home buyers plan. Can you maybe start us off by telling us a little bit about the program and how it actually works?
Sure. So an RRSP is a plan that essentially is designed to allow you to save money for your retirement.
Okay.
The idea behind the RRSP is that once you put some money into it, you're not really supposed to touch it until you retire. However, our nice government lets us take some money out of it if we buy a home.
Okay.
And essentially the way it works is you are able to take out, let's call it a loan, out of the RRSP. Up to $25,000 that you can use that money towards the purchase of your house. The reason why I call that a loan is that it's not really free money. You actually have to repay it back.
What? No free money?
No free money, unfortunately. But it is a nice way to get some capital out of your RRSP when you need to buy a first house, because obviously it's an expensive thing to do.
Okay, so awesome. Let's maybe just back up and we're gonna maybe talk about a few of the pieces.
Absolutely.
So like, okay, first of all, I mean, I think most people know, but just to be like perfectly clear, what are the benefits of putting money in my RSP, particularly from a tax perspective on an ongoing basis, like before I'm even gonna buy a house?
In general. Very good question. So there are a couple of specific benefits. First of all, when you put some money into your RRSP, let's say take $100 and put it into your RRSP, you can claim a deduction on your tax return of the $100 that you put in.
Okay.
What that does is it lowers your income. And because your income is lower, your tax bill is now lower. So that will either cause you to pay less tax or cause you to have a refund, one or the other.
And it's called like a deduction or tax sheltering, right? There's a couple of different words out there.
It's called the deduction specifically. Now,
okay,
the second thing that you mentioned, tax sheltering, that's a second benefit of having an RRSP. Once you've taken that $100 and you put it inside your RRSP, you can invest that money in something within your RRSP. So this could be a bond, this could be stocks, this could be a JC, pretty much not anything, but almost anything that you can think of. And as that investment continues to stay within your RRSP, whatever income it earns is not subject to tax. And that's what we call a tax sheltered investment. It doesn't trigger anything.
Got it. So I've got the benefit, I put money in to my RSP every single month. That's being deducted from my income, so I'm paying less tax on that.
Less tax today, correct.
Right, and then there's gonna be the benefit of the money inside my RSP is growing without having to pay tax as well, and that's the sheltering piece.
That's the sheltered piece,
okay,
correct.
so this is already like a double benefit before we're even talking about the home buyers plan.
Pretty much.
Okay, cool. All right, so you're saying that there's $25,000 that we can borrow as a loan from ourselves, is that right?
Essentially, yes. So the RRSP that you have, this is your own money. This belongs to you. Even though it's held with a bank or some sort of financial institution, it is your money. You're not allowed to touch it until you retire. And by the way, the other thing I should point out is once you retire, once you start taking the money out of the RRSP, you will have to pay tax on that money then. So that's the downside. You put money in today, you get a deduction, it grows tax-free, but eventually you're going to have to pay tax. That will happen when you take the money out.
Got it.
But presumably you're going to be retired at that time. You're not
Let's
going to be
not worry
working,
about that just yet.
and you're not going to worry about that.
Yes.
But
we're just focusing on our first house here. Like that's exciting, but we'll get there.
That's much more down the line for sure.
Right. We can, as you were saying, borrow $25,000 from our own RSPs to buy a house.
That is correct.
Okay, now is that $25,000 money I have to put towards my down payment, or is it specific to my closing costs, or like, does it matter? How does that work?
It's a good question. One of the requirements in order to take the money out is that you need to have a written agreement in place to purchase.
So like a purchase and sale agreement.
Correct.
Okay.
And so typically, I mean, you're obviously the real estate expert, but from my limited experience in that area,
oh come on, give yourself some credit.
from what I understand, normally when you sign the purchase and sale agreement, there's typically a deposit of the company's in. So
say that part again.
There's typically there's a deposit that goes with the purchase and sale agreement.
Correct.
So in order for you to take something out of your RRSP, you first need that written agreement to buy a house.
Got it. So once
so that has to come first.
Got it. So step one, we're going to have a purchase and sale agreement, and it's going to be signed with the deposit. There has to be at least $1 exchange to make the contract valid, although I don't think I've ever seen someone put a $1 deposit. I've gotten away with $100 a couple times, but that's a separate point. So once we have that, we've got this signed, we are now then in a position where we're eligible to take the money out of our RSPs.
Correct. And now you can go back to your RSP. There is a form that needs to be sort of put together, and they ask you some basic questions to make sure that you're eligible. And after that, you can go to your bank and say, okay, I would like to take out $25,000.
So I just want to pause you there for a second, because you said some forms. Are there some forms that need to be filled out before you go to your bank, or how does that all come into play?
Good question. So there is a standard form from the Canada Revenue Agency, or the CRA. I believe off the top of my head it's form T1036.
The accountant in you. What did you say?
T1036.
T1036, okay.
If I, for some reason, messed up the number, go to the CRA website, type in home buyer's plan, and you'll find the form.
Okay.
And that form, at the top, asks you some questions to make sure you're eligible. So it asks things like, have you owned a home before? Are you a Canadian resident? Do you have an agreement to buy a house? And et cetera, et cetera.
So do you have to fill out the form, or you just sort of like check, I qualify, and then you move forward?
You want to fill it out as complete as you can, and then take that form and bring it to your bank.
All right. And I'm also assuming that if I go to my bank and I have my purchase and sale agreement, either they will give me the form or direct me to get the form.
They probably will. They've done this song and dance.
They've done this
a few times, so even if you come without a form, they'll find it, they'll give it to you, or they should be able to do that for you if you're dealing with a good bank.
Okay, and then I will fill out that form, and at that point, what happens? Let's say I had $25,000 in my RSP. Do they write me a check? Do they give to me, like, what happens?
What happens? So there's a part of the form that they have to fill out. I'm not sure if they can do that on the spot, or maybe they'll take them a little bit of time to do so, but as long as you qualify, they are now essentially authorized to give to you $25,000 out of your RSP without any tax consequences.
Got it. Now, here's actually a nuance. I don't know if you know this, but I'm going to try you anyways.
Go for it.
What happens if you going through the process of real estate, and you go through the conditions, maybe you have the home inspection, or you don't qualify for financing? I guess you have to give that money back if it's already been initiated, or I don't know if the bank will only give you the money from your RSPs once you have removed all the conditions.
It's a good question.
I don't know if you know. I feel like
I don't know, because you're right. There could be
like real estate meets banking meets accounting.
The only condition on being able to withdraw the money is that there has to be a written agreement. Now, if there's conditions associated with it, and there are some of them that are not fulfilled, it's a good question, because
well, you obviously have to give it back, right?
At the end of the day, if you take it out but you don't buy a house, you're going to have to put it back. And so could very well be the case that maybe your bank will ask you, did you go through it? Because if you haven't, if there's some condition that's still outstanding, then they might say, well, why don't we wait until you actually fulfill all the conditions.
Okay, so how, maybe from your experience or some of your clients' experience, do you know typically how long it takes for the banks to give the money to you?
It's a very good question. I personally have not gone through this situation, so I don't know myself from personal experience. I don't want to also speculate, because from dealing with the banks, they tend not to always necessarily be very quick. So you may, if you're going to do this...
I love how politically correct you are.
Well, I try not to offend people.
No, I love it.
I would suggest, if you're going to do this, maybe before you actually go through the process, approach your bank, particularly the institution where you have your RSP, because that might be actually different from the bank that you don't deal with.
That's a good point, yeah.
And ask them, I'm thinking of taking out money under the home buyer's plan. How long would it take?
That's really good.
You might want to do that ahead of time, just so you have an idea what the time would be.
Yeah, no, I think that's a really good point, especially if you're banking with or I shouldn't say if you're banking, if your RSPs are with I don't want to call them an insurance company, but like...
Yeah, but like a non-traditional
bank, yeah. And especially,
bank.
I mean,
Absolutely.
The times that I was working with those types of financial institutions was when my company that I was working for was matching my RSP. So if I wanted to get the company matching, I had to be with some of these sort of alternative kind of banks. And definitely things take a little bit longer in that scenario.
For sure. And there are some institutions where they do everything online, that they don't even have branches necessarily. So in that situation, it might take a little bit longer. longer. It might not be as
Right.
easy as you just walking into your local branch and saying, okay, can you tell me what the answer is?
Yeah, so actually what's coming to mind for me is in terms of like the process on lining everything up, like, you know, line them up and knock them down, is probably you want to engage that financial institution right away as soon as the purchase and sale agreement is signed off on.
I would say that's a good idea, and maybe
Get the
even
ball rolling.
maybe even ahead of time, like, because presumably before you even buy the house, before you sign the purchase and sale agreement, hopefully you've done some financial due diligence and you figured out, okay, how much can I afford? Where's my down payment actually coming from, and so on. And I think part of that process may be you actually engaging your RSP provider and saying, how much can I take out and when can I take it out?
And I think what's important about that is because your RSP is hopefully not sitting straight in cash. So you may be in an investment that's easier to get out of. Maybe there's some penalties. Maybe there's time constraints depending on like if you've locked into something. What are the implications?
Very good point. So I personally do have an RSP and I mostly hold equities in it. So if I wanted
like
to actually
stocks,
correct.
Right.
So it's not sitting in cash. It has, you know, an investment component to it. And so obviously, if you wanted to take that out, you would first have to sell them.
Right.
Now,
is the market up?
Is the market up?
Down?
Is the market down? Do you want to do it all at once? Do you want to? Some people suggest if you're going to sell, maybe sell in little batches because if the market goes up, then you're benefiting from the from the uptick. So you're right. It's not sitting there in cash. Your RSP is not like a savings account that has a bunch of cash sitting in it. And if that's what your RSP looks like, that's actually a bad thing because that cash isn't earning.
Well, unless you just did that because you were super savvy and you knew you were going to be buying a house.
Yeah, if you did that ahead of time, then good for you. Then you're ahead of the game already.
There you go.
But normally you'd have some sort of investments there. So absolutely you would have to liquidate them first. And if you bought something like a GIC where you're locked in, then maybe can be a little bit more tricky.
Yeah, my RSPs are not very liquid at this point in time, and they're actually in mortgages. Totally separate conversation for another day. But yeah, just kind of taking into consideration what that looks like.
Exactly. It may not be as simple as just saying, okay, give me $25,000.
Yeah, give me my money. It doesn't always work that way. Okay, so let's kind of back up a little bit to a couple of the other components. So we know what the process is going to look like, but how do you actually even qualify? Because I know that the first-time homebuyer definition for this
it's a bit of a misleading definition.
Is a little bit confusing, and actually in some ways maybe advantageous because you could maybe even be a first-time buyer more than once in your life. But what is the definition? How does that work?
That is very true. So the definition of a first-time homebuyer for purposes of this program is a person that has not owned and occupied a home in the previous 4 years.
Right.
Nor did that person have a spouse that did the same thing. So if you're married, neither you nor your spouse owned a house and lived in it in the last 4 years. So in theory, if you lived in a home that you've previously owned, let's say 6 or 7 years ago, and you sold it, now you've been renting, and now you want to be back in the market, you can technically be a first-time home buyer a second time or a third time.
And I actually think that this happens maybe a little bit more often than people may think. Like especially I know with like the Toronto market being so hot and the Vancouver market being so hot, I know quite a few people who had purchased property and it significantly appreciated, and then they actually sold it to capitalize on that, and then we're renting on another part of town. So maybe, you know, if 4 years passes, the market cools down, they decide to buy again, they actually could qualify a second time around.
Yeah, absolutely. If you're in one of those situations, which probably for most people isn't the norm,
It's not the norm, but I think that there's more like anomalies and interesting things happening in the market.
So if you're in one of those situations and if you've previously used a home buyer's plan, you may be able to use it a second time. Absolutely. Even though, you know, you're supposed to be a first-time home buyer.
Yeah.
Don't think that if you've ever owned a house before that you can never qualify as a first-time home buyer. You may, because the definition puts a time limit on it.
Right. Now, what happens when two people are buying a property together? So let's say there's a couple and they're buying it together and neither of them has owned it before. Do they each get $25,000 that they can put in, or is it like one person per property? How does that work?
Excellent question. So an RSP belongs to one individual person. So you may have a situation where you and your spouse, for example, both have RSPs.
Right.
In that situation, each of you is allowed to take out up to $25,000 out of each person's RSP.
Okay, so we could actually put in $50,000.
Correct. If each person has enough money in their RSP account. Yes.
Right. Okay, that's cool. So another nuance is like, what happens, you know, if I and I see this quite a bit with first-time home buyers, if I, have been struggling to put money in my RSP, like I know it's the right thing to do for my retirement and like for all those tax benefits that you told us.
You don't always think about the retirement when you're
pretty young,
right?
I just, I've seen people who are like want to travel, but they've actually got really decent incomes. And I think it's more and more popular now that, especially with the crazy prices in like Toronto, Vancouver, that we have families who are gifting us money or are helping us. So in that instance, something that I've kind of thought of, and I'm interested in your take, is like, if I've not been maxing out my RSPs and my family is going to give me a gift of, let's say, $25,000, do you think it's a good idea to take that money, put it in my RSP, and then take it out of my RSP? And like, what are some nuances? I know I think there's some time frame things. Can you maybe talk about that a little?
Absolutely. So,
and is that totally legit? Because this is like my like sneaky behind the curtains idea.
It's totally legit. It's not something that's a scam or anything like that. It's just good planning.
Okay, so it's financially fabulous?
It may be, depending on your situation.
Okay,
I don't want to say it's automatic.
Okay, no, I like that. I like that.
It may be a good idea to do that if your family is giving you some money to put into an RSP first. However, a couple of things you want to consider. One, if you're going to do that, there is a rule that says that any money that's been put into an RSP can only be withdrawn under this home buyers plan program if it was in there for at least 90 days.
Okay, so 3 months it has to stay.
Correct. So you can't put the money in today and take it out tomorrow. That's not going to work. So it has to be there for at least 90 days. So if you were thinking of doing something along these lines, you'd have to time it so that it's
got to be like proactive, right?
Correct. You'd have to plan it out ahead of time. And 90 days is not a insignificant amount of time, but it's going to take a little bit of time for it to sit there.
Okay.
The primary benefit of putting the money into the RSP is that you get a deduction for $25,000 against your income, which will lower your income, therefore lower your taxes, and therefore probably will get you a refund or reduce your liability. That is a significant benefit. The amount of that benefit depends on how high your income currently is. Okay. In Canada, the more income that we make as individuals, the higher is our tax rate. So if you're at the very, very top...
Isn't it fun to make more money and pay more taxes?
It's fun with a capital F, yes. So if you are a person that does have a lot of income, you would benefit significantly from a $25,000 deduction, and you may be able to get a big refund in that same year.
That was what I was going to ask. Is the $25,000 sort of deduction, if I'm saying this right?
Absolutely.
Do I have to use it all right now? Can I go backwards? Can I go forwards? Like, I mean, I'm planning to make more money in the future. I hope you guys are planning to make more money in the future. Like, can I use it at a later stage?
Excellent question. You can use it at a later stage, absolutely. So if you put in $25,000 in this year, you don't have to claim that full $25,000 deduction in the same year. You can use part of it if you'd like. You can use none of it if you'd like. You can carry it forward to future years. You cannot go back though.
You can't
go back, but
you
can go forward and save it for next year, and it never expires. So you can save it for as long as you want.
That's cool. But this actually, to me, sounds like I need an accountant to help me file my taxes. If like I'm trying to move some stuff forward, some deduction this year, it feels like I need an accountant stepping in.
You may, once you get into these little nitty-gritty things, you may want to ask someone for some help, because there's a lot of software available there to do your taxes, but if you don't know what you're doing, the software won't really do it for you. You kind of need to know what you're looking for. So with little things like this, it could get a little bit tricky, and you might be missing out on a benefit that you don't know about. So once your tax situation starts getting a little bit more complicated, once you have a house and a rental property and 2 rental properties and an Airbnb and all this stuff, you may need some help at some point. Absolutely.
Okay, so I feel I have always used an accountant because I've always had this concern that there's like something that I'm missing out, and I was worth paying an accountant to make sure I didn't mess up my taxes. I know lots of people, especially when they're simple, do them themselves. Like even when mine were super simple, I was too afraid I'd mess it up. Yeah, I don't know. That's just me anyway.
I think you would make a great client, that's for sure. I would say...
A loyal client, for sure.
Definitely a loyal client as well. I would say that, if your situation is pretty simple, and what I mean by simple is you have a full-time job, you have essentially income from one source, which is from employment. You might have maybe a couple of small donations or something. That's a fairly straightforward situation, and something like that you can easily handle on your own.
Probably
if you've done it a few times. However, once you start getting into things like investments, owning multiple properties, a lot of people do Airbnb type activities nowadays.
Yeah.
As soon as you get into those types of things, that's
Don't
a
try to
whole
do it
different
yourself.
world. And whatever software is out there, it'll help you only if you know what you're doing. And if you don't know what you're doing in these cases, it's best to probably call somebody for help.
Yeah, I'm a huge fan of paying the experts. So while we're talking about kind of the accountant role and like tax stuff, can I ask you a couple questions in that vein?
Absolutely.
Okay, perfect. So the first one is, I think, and correct me if I'm wrong, there is a tax credit that you get when you buy a home for the first time, but you have to include it or ask for it when you file your taxes next time around. Is that true? What does that look like?
That is correct. You must have done this a time or two.
Well, yeah, maybe, I don't know.
Maybe your accountant did it for you.
Actually, for sure, my accountant did it for me. Maybe they told me about it, but I just want to be perfectly clear on how that works.
Absolutely. So there is something called a home buyer's tax credit.
Okay.
This is one of those things that if you don't know what you're doing, it's very easy to miss.
There you go.
You may want to either ask somebody who's an accountant to help you with this, or at least
Yeah.
now you'll know to at least look for it. So there is something called a home buyer's tax credit. It is a credit that reduces how much taxes you owe to the government. However, it's what we call a non-refundable credit. So if you don't owe any taxes, you won't get a refund. It'll just reduce how much taxes you
And
have
is it a
otherwise
fixed
paying.
amount?
It is up to a maximum of $5,000. And the credit itself is multiplied by 15%. So the net savings is $750. It's $5,000.
Okay, I was going to say 5,000. I thought it was $750.
It's $750.
Can you say
Correct.
that math just one more time so
Sure.
I can make sure I...
So the way that credits are calculated using a percentage is 15%.
Okay.
And the gross amount of the benefit is $5,000. You multiply by 15%. So the net credit that you get is $750.
Okay,
so it
so-
reduces your taxes by $750.
So basically, if I purchased... And is this a first property or any property? Do you know?
This is also for first-time buyers.
For first time buyers.
Yes.
Okay, so if I'm buying my first property and I had taxes of $750 or more that I owed to the government throughout the year,
Correct.
whether it was like deducted off my payroll or I was self-employed and I had to sort of pay it
yourself?
in.
Yeah, either
Yeah,
way.
so if it was $750 or more, because I bought my first house, I can actually get a one-time credit of $750.
Correct.
But if I owe no taxes, I don't know how that happens.
If you're unemployed and you do nothing,
Right.
the government will not give you $750.
Got it. So you'd be better off incurring some taxes so that you can get them back.
Yeah, and realistically,
Sort of.
and realistically, in order to purchase a home in the first place,
You gotta have
you're
some
probably
money.
gonna have some income anyway. So this
True,
usually
you got to
isn't a
qualify
problem.
for a mortgage,
Gotta
right?
qualify
Okay.
for a mortgage, have some money for down payment, and so on. So usually this is not an issue. People usually can benefit from it.
Right. Okay. And I know that this isn't exactly in the accounting world, but we'll just kind of touch on it, is that there are other rebates on like land transfer.
Mm-hmm.
And typically that stuff happens with the lawyer and during the transactions you get the rebate back right away. But
Mm-hmm.
is there sort of any tax element on that you think is worth noting?
Just so that people are aware of it, really, when you do purchase a home, there is something called the land transfer tax.
But it does depend on your province.
It does depend on your province, correct?
So Alberta, no land transfer.
It's obviously, Alberta's been a very good province to live in for
It
many,
has
many years
been a
for
great
many
province.
different reasons. There's no sales tax there either at the provincial level. So,
But
However-
I wouldn't trade living in Toronto.
well, there you go, right?
I just
If
have
you-
a little bit of love for Toronto, but yes.
So if you're fortunate to live in Toronto, like the financially fabulous person that you are, you're actually, interestingly enough, subject to 2 land transfer taxes. You're subject to...
Aren't I special?
We all are
Everyone in
special
Toronto, right? Yeah.
So in Toronto, in the municipality of Toronto, you are subject to a so a municipal land transfer tax, as well as a second provincial land
Right.
transfer tax. Whereas
Okay.
in most other places, you just pay the provincial, there is no municipal.
Right. And Quebec has a really interesting welcome tax that I'm not even going to try to talk about here, but you want to make sure that you factor that in as well.
Clearly, if you want to move to Quebec, they want to welcome you with open arms.
I love it. Welcome.
So with the land transfer tax, some people don't realize that it exists, and it could be very significant. And so to make sure that you, A, are aware that it exists, B, factor it into the amount of money that you actually need to finance the purchase for. There are some really good tools online. If you Google land transfer tax calculator,
Okay.
there are multiple resources that you can basically put in the purchase price of your house, click a button, and it will tell you what is the municipal portion for Toronto properties and what is the Ontario portion. And that will be an added cost to you on closing.
Right. So, I mean, I think that there are some great resources, and Google may be an okay place to start, but there's also lots of not legit things on the Google. So I would recommend actually chatting with your mortgage broker, because they can also help you to find out exactly what that means for you. So there may be some great sites out there, but I don't want you accidentally falling on like the wrong site and you think you only are going to pay $5,000 and all of a sudden it's 10, but
I can also add that most banks will have a calculator like that. So if you go to like TD Bank or Royal Bank or whatever, most of them will have a land transaction calculator, and you can typically trust that the bank will do the right thing.
Yes, no, absolutely. Well, yeah, that could make a lot of sense. All right, so that's that piece. Now, what about HST?
HST, the ugly three-letter word. So HST is, don't you know enough taxes? Look how many different taxes we talked about already. Income tax.
Now, let me ask you, are taxes sexy? In
taxes, you know what? They could be sexy, depending on the depending on the time.
Only when they're refunds, right?
Pretty much.
Okay.
The profession itself is not very glamorous. Although there was a movie recently called The Accountant. I don't know if you've seen it. I
have not, but it's Ben Affleck?
It's yes, I believe so. And I gotta say, it's really nothing like what we actually do in practice. But
so that's probably why it was sexy.
Probably.
Okay.
The opposite is actually the real life, unfortunately. But,
okay, so back to HST.
Back to HST. So HST may apply in the purchase of a house, primarily if it's a new property. If you're purchasing a resale home, HST will not apply. But if you're purchasing a brand new home from a builder, whether it's a condo or a single family dwelling, HST will be applicable in that transaction. What's interesting about HST is that when you're purchasing a brand new property, sometimes the HST will be embedded in the price. So in other words, they'll tell you it's, let's say, $500,000 for the property, and that includes HST already. Other cases, I had a client recently who looked at this. The purchase price excludes HST, and HST is added on closing. And if you
that must
have
been quite the bill they weren't expecting.
That was a very large shock to this person that I was working with recently. So it's something that you need to be aware of, specifically when you're buying a new property.
Now, what if there's been like an addition on the back? Like, can HST sometimes sneak in when we're not expecting it?
If you are you making the addition, or are you buying a property that was renovated?
I don't know either.
Well, if you're making the addition yourself to your existing house, then you are going to be paying for labor, for materials, and there's HST on all those components. So you are kind of indirectly paying it yourself.
Okay.
If you are purchasing a house from someone who made an addition or renovated it, HST may or may not apply. In most cases, it does not apply unless the property was redone so drastically that it's really just a new house.
A new house. Okay, that's interesting. Now, even in like a standard contract, when I'm buying like a resale, so a house that already exists, there is a line there that says like, is HST included or excluded? So I always make sure that it says included for no surprises, but even if it said excluded, again, this may be a little bit more outside of your world, but if not, let me know. If I were to write excluded and it's a resale, there really is no HST, or is there some instance where I could be charged more than I expect?
Good question. This is a little bit out of my area of expertise.
That's where I thought.
But if it is a resale property, unless there was some really major fundamentally changing rentals done to it, HST should not apply.
Okay.
But to be safe.
Included. So that's included. In the contracts, when it says HST, I always make sure it says included, because then you know for sure what the price is going to be.
And therefore, you're not going to get a surprise when it comes to closing, and all of a sudden you need an extra 30, 40, 50, whatever the case is, thousands of dollars.
Right.
Absolutely.
Okay. Cool.
Now, the thing that we haven't talked about yet is that if you do buy a new property, and there is HST on it, there is something called a rebate that you may qualify for if you buy a brand new property.
Okay.
And in order to do this, you're definitely going to need to hire someone to do this. This is not something that you can do on your computer. Feel free to call me if you like. And basically, you can get back a portion of the HST.
On some of the rebates, your lawyer will give you the rebate right on closing. There's other instances, like I think the HST, you actually have to apply for it.
Correct. So the HST rebate will not happen on closing. So this is something that you should not be counting on to be there on closing. What the process for getting this rebate is, once your deal closes, there's some special paperwork that you need to send to the Canada Revenue Agency.
Very special.
Very special. There's some forms that need to be filled out, and they ask for some specific documents in support of information relating to the purchase.
Got it.
My suggestion would be hire an accountant to do this, because it's not something that's very simple.
Yeah.
And once the information and the documents are put together, that gets sent to the Canada Revenue Agency.
Okay.
They have a separate department that deals with processing these HST rebates, and it could take, several months.
I was going to say, it could take some time.
Could take some time.
Yeah.
CRA has been actually pretty good lately about doing a lot of things online. So there's a lot of things you can actually file electronically. Right. This is not one of them. This has to be sent in paper format by courier to them. And it'll take some time to do.
Yeah, and I think that the big thing is, just don't bank on that right up front. Like, you're going to have the cash in your pocket to be able to dish it out and then get it back at a later stage.
Correct. I had a client recently that I did this for, and we submitted this application, I think it was in December of last year, and they finally got a response, I think it was in May. Okay. May or June. So
it could be a good 6 months before.
Yeah, probably about 6 months, because there's a lot of transactions that happen in this country.
And the rebate is not 100%, right?
It is not 100%. It is definitely not. And without getting too technical, there's a different percentage for the provincial portion and the federal portion, and you
hire
have to
an accountant. They'll help you figure it out.
Get a numbers guy to do this for you.
Yeah. Absolutely. Okay. Perfect. All right. So those are all of the taxes that we should be thinking about in sort of purchasing the house. We talked about a variety of different ones. Now, if we go back to how the program works, we talked about $25,000. Maybe your parents are going to help you. We know some nuances about that. But let's talk about paying it back. And I like that you called it a loan, because I was like, free money, but it's clearly you got to pay it back. But you're borrowing it from yourself. Mm-hmm. Right. Okay, you're borrowing from yourself. So let's talk a little bit about how you pay that back. Is there interest? How do you know how much to pay? How long do you have to pay it back for? Like, maybe fill us in a little on that.
Sure. So it's a good point that you said that you should call this a loan. It is definitely not free money. It's not that, oh my God, I take a bunch of money out of my RSP and that's it. You have to pay it back into your RSP. You have to start paying it back in the second year after the year in which you bought the property. So for example, if you bought something in 2017, go 2 years from now, you would have to start repaying in 2019.
Okay.
Because of this 2-year rule, if you let's say you are looking at a property and you're thinking of,
but you can start to pay it back in the first year if you want to.
I don't think I've ever seen anybody want to do it.
I don't want to.
That early.
Okay.
You probably could, to be honest with you, but most people just wait until the second year.
Second year.
Because
you have a lot of costs.
Exactly. So if you're purchasing a property,
you need furniture.
You're gonna need a lot of things. Furniture. You're probably gonna get like a lawnmower, a snowblower, things that you don't even think of until you actually move into a place that's brand new, right? So 2 years is when it starts.
Okay.
You have to repay what you took out over a 15-year period.
So this is why I was actually asking about the first year versus the second year, because I knew it was over 15 years, so I kind of assumed, does the 15 years start at year 2, or does the 15 years start at year 1?
15 years start at year 2.
Okay, all right, now I totally understand this, because I was like, now we have 14 years, so that makes perfect sense.
Correct. So you start in, so if you bought a property in 2017, you're going to start repaying in 2019, and 2019 is the first year of repayment. You will have
14 after that.
14 after 2019 as well.
Yes.
Essentially what happens is whatever sum of money you took out of your RSP, whether it's the full $25,000 or whether it's some lower number, divide that by 15, and that's your annual repayment that is required to be made.
Okay, and we are going to be reminded every year when we file our taxes. Your accountant can tell you, or it comes in, is it your notice of assessment?
Yes, so you can be, the main source of information for this is from actually the Canada Revenue Agency. When they process your tax return for a particular year, they send you something called a notice of assessment. It has some really useful information on there, one of which is your RSP contribution room. If you're participating in this home buyer's plan, they will give you a schedule. They will tell you, here's your total amount that you've borrowed,
right,
and here's how much you need to repay next year. So they will tell you what to do.
Okay, so if I took the full $25,000 and I paid it across 15 years, it's about $1,666 and some change.
67 cents.
I've done this on my calculator. That's how I could do it before. But essentially, when I pay that, you know, 1,666 every year, is that part of my contribution? Is that outside of my contribution? How does that work?
It is completely outside of your contribution room.
Okay.
So it does not reduce how much you can contribute in the future.
Right. So would I want to pay it back faster? Is there a benefit? And I just want to be clear. Am I paying interest or is it like interest free?
It is interest free. So even though this is a loan, it's a loan from yourself and you're not charging yourself interest on it. No. So if you borrow, let's say 15,000, you're going to pay back exactly 15,000. No additional interest of any kind.
So let's say, for example, I was going to contribute $2,000 to my RSPs. Okay, and let's just make the math really simple and say that it's $1,600 that I owe. Okay, to pay back to my home buyer's plan. That extra $400, does it matter? Like I'm paying, I want to put money in my RSPs anyways. It's still going to grow. Like, should I contribute it? Is there a pro or a con to contributing it or attributing it, I should say, to the home buyer's plan?
Good question. So you actually have two choices. If you put in $2,000 and
yes,
$1,600 of that is your repayment.
Right.
This additional $400 could really be one of two things. It could either be an additional contribution that has nothing to do with the home buyer's plan.
Right.
Or it can be an early repayment of your future obligation under the home buyer's plan.
Okay.
Here's the difference. If you're going to call this a regular contribution,
yes,
then you're going to be able to take a deduction in the year for $400 on your tax return, which will lower your income, lower your tax bill, and therefore you'll either get a refund or will reduce how much you owe to the government. If, however, you call this a repayment of the amount that you owe under the home buyer's plan,
right,
you do not get a deduction. So there is no benefit to you in that year. You don't get a refund or anything. However, your benefit is a little bit of a different type of benefit. In the future, instead of owing an additional $400 under the repayment plan, you now owe $400 less.
Okay, so what's really going off for me are these alarm bells saying that, you know, there really isn't that much of a benefit to repay it early because I may not owe it in the future, but that $400 could reduce my tax bill today, and I always want to reduce my tax today and, you know, we'll worry about next year.
I would say that's the case. And
yes,
especially if you know, if you're reasonably comfortable that over the next 15 years, you're going to have enough cash flow annually to meet that annual, let's say $1,600 repayment that you mentioned.
Yeah.
And if you're putting any extra money in, you're probably better off from a tax angle to call that an additional contribution, lower your income, get some money back.
Yeah, I'll be honest, I actually kind of forgot about it almost 1 year. You know, I've been self-employed in the last 2 years, and in my first year, I was kind of thinking like, oh, you know, do I really want to put money in my RSPs? I really tried to put in as much as I could in prior years, and I was thinking like humming and hawing, and I called my accountant to just be like, hey, what do you think? And he was like, Limor, don't you forget, you owe that much to at least repay back the home buyer's plan. So, you know, I think that's a really good point to just keep that in mind because, you know, it may not be top of mind 5 years or 7 years down the road if you're on, I don't know, maternity leave or you're unemployed or you're traveling for the year. Like if you're making a life change, you still have to pay this back.
That's true. That's true. And it's a commitment that's going to be there for 15 years. If you feel like you'd rather pay it off early, you could. You know, in year 2 or year 3, if you want to pay off the whole amount, by all means, go ahead and do it.
I'm going to interject and say if you have that kind of money, you better be investing it or double thinking before you're going to pay that.
That's probably a better use of it, correct.
No, but you're right, you can pay it back.
If you wanted to repay it back, you could. But most people don't. Most people say, listen, I have a 15-year window. If I have extra cash during that time frame, I'll use it for something else.
Right. Okay, that makes a lot of sense. So we know now that it is in fact a loan, and we do have to remember to pay ourselves back.
Correct.
Over the next 15 years.
What I should probably add is what happens if you don't pay it back?
Yeah, what happens?
Some people, they'll either forget or they may get the notice and still not do it. Maybe they go on vacation, whatever. If you don't pay it back, it's not the end of the world, but what will happen is, let's say you owe them $1,600 for the year.
Right.
If you forget to repay it, the government will include $1,600 in your income.
Oh,
so you will have to pay tax on $1,600.
And it will depend on how much income you already, I'm guessing, on how much income you're already making, and depending on the tax bracket, that's how much you'll be charged.
Exactly. So if you're in a really high tax bracket, your tax might be 50%. If you're in a really low tax bracket, it might only be like 20%.
Right.
So it depends how much taxes you would owe. But that $1,600 will be added to your income. It'll increase your taxes for that year.
Okay, so if you can't pay it back, try not to forget, because you really don't want to pay extra taxes.
No, and now the other downside of it is if you did repay that money is now sitting inside your RRSP. It's now going to be invested in something. It's going to be earning you a return.
So it's back. It's like my money back in my RRSPs again.
Again, and you can use that to buy equities, you can buy a JC, and it's going to make money for you, right?
Right.
So by not repaying it, you've lost that opportunity to put $1,600 back into your RSP, which can actually make a return for you.
Right. It can be a little bit tough to wrap your head around that, but basically that money is now in a position to earn more money for you, so your RSPs grow even faster and bigger and all that kind of good stuff.
And when you retire, hopefully you'll have a lot more to retire on.
That sounds great. That sounds great. Okay, I want to switch gears for a moment. With the current markets being as hot as they are in multiple cities across Canada, there are lots, particularly millennials, and I don't have a stat for this, but there's lots of people who are now getting more financial assistance from their families. And we talked a little bit about if you're going to get a gift of money, you know, if it makes sense for you, put it in your RSPs. But what happens, or I'm curious on your thoughts on when your family is not necessarily just giving you money, but they're helping you to qualify for the mortgage. You know, they're a guarantor, although, you know, it's harder to become a guarantor now. Family is more of a co-borrower, which means they are registered on title. So let me just kind of backtrack and say, like, typically it's harder to qualify for a larger mortgage with someone just as a guarantor. They now need to be a co-borrower. If they are a co-borrower, they are then automatically on title. And, you know, you have some options about being 50-50 on title or 1%. And I've had some conversations with lawyers, and we've had Ryan on here, so he's kind of explained a little bit about that. But where that conversation ended and where I want to pick it up with you specifically is, what does that mean from a tax perspective for, let's say I'm buying a property and like my dad co-signed, and so he's on title with me. It's my primary residence, but not his. This is a really long question.
It's okay.
So I'm just making sure you're tracking.
I'll just take a sip while you're talking.
Go right ahead. Yeah. So in the future, you know, when I'm selling a property and it's been my primary residence, hopefully the value has gone up. I don't have to pay tax on the capital gains, but I may not have owned that property 100% myself. So what could that mean for the parent who co-signs and is on title from a tax perspective? I heard that there's this thing where you can like transfer it for $1. Can you maybe just talk about all of that good stuff?
That was a really long question.
I know, that was a really long question.
Want to start over again? I'm just kidding. Well, let's go back to the first thing, which was putting somebody else on title, right? Particularly if it's your parents, if they're going to be helping you out with the financing. The way that this works for tax purposes is it'll impact something called the principal residence exemption.
Okay.
Principal residence exemption is a tax rule that helps people. It allows you to not pay tax when you sell a home that is your principal residence.
Okay.
So if you live in a house, it went up in value, you sell it, regardless of whether you move to a new home or not, you don't have to pay tax on the appreciation.
Is there a minimum amount of time you have to have lived in that house?
There is no minimum amount of time, but you would have had to live in it.
Okay.
So there's not like, okay, you have to live here for at least 3 years or 5 years or something like that. As long as it was your primary residence, you actually did live there, that's fine. Now, what you're describing with the percentage ownership will...
In my really long question.
In your really long question. In the multiple facets of the long question, I'm going to try and start one by one.
Yeah.
The different percentage ownership may impact your ability to not pay tax when you sell your principal residence. And here's how. Normally, if you own your house outright and you own it 100% and you live in it, there's no question it's your principal residence. So when you sell it, 100% of the money you made on it is going to be tax-free.
Okay.
Now, if we compare that with a situation where, let's say, I'm the person who's buying the house, I'm going to be living in it, but my parents need to be untitled because they're borrowers as well.
Yeah.
If they're going to be untitled with me, they're not going to be living in this house.
No.
And they presumably have their own home in which they do live, which is actually their principal residence.
Right.
So their portion, their interest portion in my home doesn't qualify as a principal residence. Only my interest in it qualified because I'm the one who lives in it.
Right.
So in that example, let's make it to an extreme. Let's say I have a 50% title in my house and my parents have the other 50%. If that house later gets sold, I technically would only qualify for 50% of the principal residence. The other 50% legally belongs to my parents, and that portion is not their principal residence. So they would have to pay tax on their 50% increase in the value of this house.
Right. So I'm seeing a lot of alarm bells here because unless, you know, your family is helping you and you've had this conversation with either an accountant or a lawyer, it may be presumed you're both buying it 50-50 and you could have some significant tax implications in the future.
Absolutely. And a lot of times during the closing process, you may not even tell your lawyer how you want the property registered until like 2 or 3 days before the actual closing happens.
Right.
And so at that point it might be a surprise and it might be too late to kind of do anything about it. So this sort of thing, if you are going to have parents helping you, you should have a conversation with them and your financial institution who's going to be requiring them to be untitled as to what percentage they can hold. What I have seen in practice is sometimes you see a situation where I would be, let's say, the 99% owner on title, and my parents would have a 1% interest.
Right.
And in that situation, if we sell the property, because I was living there, it would be my principal residence. So at least 99% of my profit is not going to be subject to tax.
Yeah. But I've also seen scenarios where it's like 95.5%, like people who've kind of made arbitrary decisions, maybe without necessarily understanding what is the tax implication in the future, right?
Absolutely. I can tell you that Canada Revenue Agency, particularly in the last couple of years, has been a lot more aggressive, I would say, in looking at people who buy and sell houses. And it's not really a surprise because the market, especially in Ontario and Toronto specifically and Vancouver, has been really, really hot. But real estate in general has been going up in value. Okay. Canada Revenue Agency, from what I've experienced, actually does have access to the land registry office and they can see who does the title belong to. Right. So if your parents are going to be untitled, I would say there's a risk that CRA might say, oh, well, they're 10% or 5% or 50%, whatever it happens to be, you would have to pay tax on the appreciation associated with that because that's not their principal residence, it's only yours.
Right. And so then the scenario where you can transfer the property for $1, my understanding of that is it may help to decrease some of the land transfer costs, but not necessarily the capital gains.
When you're saying transfer the property for $1, you're saying after the property is purchased, the parents would transfer their part of it to their son or daughter?
Yeah, so maybe now we're jumping to the legal side, which is maybe outside of your world.
It's okay. If that happens, from a tax angle, anytime there's any sort of purchase or sale between non-arm's length people, so people who are family, regardless of what the consideration actually is, so in this case it's $1, for tax purposes it would be treated as having happened at fair market value.
Right, so I think that's where the transfer piece, you can have a decrease on the land transfer, but not on the tax side.
Correct.
And if I'm connecting all the legal and accounting dots correctly.
I think you're right. I think on the land transfer tax, that's a slightly different way that they deal with it.
Correct.
But from an income tax perspective, if my parents had a 50% interest, let's say, in my house, and then at some point down the road, they signed it over to me for $1.
Right.
For an income tax perspective, CRA is going to say, well, I know he's your son, I know you gave them this really good deal, but in reality, if you were two regular people, two strangers dealing with one another, they would be charging you whatever the value of this thing is.
Correct.
So we're going to do the same to you.
Got it, got it. So I think that the big aha here is that while we may not typically think of an accountant as someone that we need to consult with, have conversations with when you're buying a house, there actually are some potential implications to really consider.
Consider, absolutely. You may want to, especially depending on how complicated your situation becomes. If you have a lot of people that are contributing some sort of financing, if they're going to be on title, if you're thinking about using your RSP under the home buyer's plan, you may want to get some advice.
Okay.
If you're, if you're qualified for your own mortgage and God bless you, you don't need any RSPs, then you probably don't need an accountant. But if it gets a little bit more complicated, you may want to get some advice, especially ahead of time.
Right.
So that when the closing actually happens, you're prepared and you know exactly what's going to happen.
I love that. That makes a lot of sense. So we talked about a whole bunch of different angles. Is there anything that really stands out to you that you see a lot of first-time home buyers doing, which is wrong or is a mistake or is costing them a lot of money? Maybe just as a bit of a call out, maybe it's in the areas we've talked about, or maybe it's something else.
From my experience, some of the mistakes I see are actually not even tax related. They're just related in general to personal finance. Sometimes I see home buyers, especially first-time home buyers, they underestimate the costs associated with purchasing and then actually maintaining a particular property.
That's huge.
And to be honest with you, to be fair, I did the same thing when I bought my first condo. I thought, okay, well, here's the purchase price, here's some closing costs, this should be done. And then you go into the lawyer's office and they give you like a 3-page document with all these adjustments. You're like, what is all this? Why am I paying 3 times to register something, to the land transfer office? So it's something that is, for a first-time home buyer, I think it's hard to deal with because they've never been in that situation before. How do you actually anticipate what's coming? My advice to you would be talk to someone who's bought a property before and ask, when you bought your condo, can you tell me like how it went down? You know, what were some of the adjustments that you were dealing with? How much did your lawyer charge you? Et cetera, et cetera, et cetera. Another good tip I would say is if you're buying a home from like a resale home from somebody who lives in there currently, ask them for information about how much is your property taxes, how much roughly do you pay in like hydro, in heat, and so on and so forth, because that will be a better indication of what your costs are going to be once you're in there. You can estimate as much as you want, but talk to someone who's actually been in that position.
No, and I really like the idea of kind of asking the existing sellers, especially for things like hydro. What does that look like? Because you can have a ballpark figure, but maybe the home isn't properly insulated, so your heating bill is going to be higher. So things that you may not necessarily know on your own.
Or that could be an indication that you might have to do some renos, which would also add to your costs, right? And so this would be helpful. I've seen sometimes sellers actually put together a little sheet that says, okay, here's my property tax for the year, here's my hydro bill, et cetera, et cetera, et cetera. But a lot of people don't. So if they don't, ask those questions. Because generally, people tend to underestimate how much it costs. And at a bare minimum, you want to know what those costs are before you sign up to, be a homeowner and deal with them on a monthly basis.
Yeah, for potentially the rest of your life.
But yeah, hopefully, if all goes well. Okay.
Well, I want to thank you so much for being here.
My pleasure.
You definitely made taxes at least a little bit sexy.
Thank you very much.
And you did it in plain English too. So you are here based in Ontario. Do you work with people only in Ontario, or can you work with clients all across Canada?
Good question. So I am located in Toronto. Most of my clients, actually I shouldn't say most, I'd say exclusively my clients currently are in the Toronto, Ontario region. That being said, I'm certainly open to working with anyone in Canada.
And like from a legal perspective, there's no issues. Like I know lawyers can only work in the province that they're located. For accountants, it's not the same way.
No, for accountants, we can have a client that's really anywhere in the world as long as we're qualified to do the work that they need us to do.
Fantastic.
So by all means, yeah.
That's great. Well, you will definitely have Alex's contact information, and if you want to reach out to him, by all means, go ahead. Thank you so much for being here. I really appreciate it.
Thank you. It was a pleasure.
All right.